Copper breaches $10,000. What it really means for the global economy. Copper has once again crossed the $10,000 per metric ton threshold, and this time, the rally is being fueled by a combination of weak U.S. producer price data, a softer dollar, and tightening supply chains. This development is not just a headline for commodity traders, it's a signal that global markets are entering a new phase of economic adjustment. The U.S. Producer Price Index (PPI) data released recently showed a lower-than-expected annual increase of just 2.6%, well below the forecast of 3.3%. On the surface, this might sound like good news, as it indicates cooling inflation. But markets quickly interpreted it as a sign that the Federal Reserve may cut interest rates sooner than expected. Lower rates generally weaken the U.S. dollar, making dollar-denominated commodities like copper more attractive to global buyers. The rally is also being amplified by supply disruptions. Indonesia's Grasberg mine, one of the world's largest copper sources, is facing a temporary shutdown, tightening the availability of metal on the market. Stockpiles of other industrial metals, including zinc, are running low. Together, these factors have given copper prices the perfect environment to surge past the psychological $10,000 barrier. This price movement is more than a trading opportunity. Copper is often called Dr. Copper because it is considered a barometer of global economic health. Its rising price may indicate confidence that industrial activity, particularly in China, is picking up. China is the largest consumer of copper, and any signs of recovery in its construction, manufacturing, or green energy sectors can drive massive demand. However, there are two sides to this story. While miners and investors celebrate higher prices, manufacturers face higher input costs. For countries like Pakistan and other emerging economies that rely on imported raw materials, rising copper prices could increase production costs for electrical goods, construction projects, and infrastructure development. The real question is whether this price rally is sustainable. If the Fed indeed cuts rates and China continues to stimulate its economy, copper may have room to climb further, potentially triggering a new supercycle for industrial metals. But if global growth falters or supply disruptions ease, prices could quickly retreat below the $10,000 mark. In short, copper's latest surge is not just a market story, it is a signal about inflation, monetary policy, and the health of global industry. Policymakers, investors, and businesses should watch closely because what happens to copper today could shape the cost of doing business tomorrow.